Markets rallied yesterday on this news that Jerome Powell would potentially end quantitative tightening, which was the reduction of the Fed's balance sheet, was fine up to a point that it begins to cause an economic drag. And at some point that would reverse. Well, it used to be $25 billion a month. They reduced it by $20 billion to $5 billion a month. And that $5 billion a month has kind of been running now for a while. And now there's a big misunderstanding about how quantitative tightening works. Yes, the Federal Reserve is still buying Treasuries. And all they're doing is they're allowing $5 billion a month to roll off their balance sheet. So they are reducing their balance sheet by not keeping the exact same amount of Treasuries on their balance sheet. But it doesn't mean that they're not buying Treasuries. So for instance, they own a lot of short-term bills, 1 year, 3 years, 5 years, whatever. So as those bills or bonds mature in a given month, so let's say that this month they are going to reduce their balance sheet by $5 billion, but they have $10 billion worth of bonds mature, they've got to go out into the markets and buy $5 billion. So they're allowing $5 billion to roll off, but they're still buying $5 billion in the market to keep their balance sheet reducing at that same rate. So there's been a lot of talk about, the Fed's still doing QE. No, they're just managing the roll off on their balance sheet. They're not really doing QE yet. Well, that's going to end. They're not going to allow a reduction of the balance sheet. This is the thesis anyway, is that they will stop allowing the balance sheet to reduce. So they'll stabilize the balance sheet. Now, again, they're not going back to QE yet. They're not increasing the balance sheet, but they're going to stop allowing the balance sheet, in theory, from reduction. So that's going to imply that if I have $10 billion worth of bonds roll off the balance sheet this month, I'm going to buy $10 billion into the market. So a couple of things that come from this are A, it provides support to the Treasury market. So as the government needs to issue debt to cover spending, this is going to provide a buyer in the markets because every month the Federal Reserve has bonds rolling off. They're maturing, and so they're rolling off their balance sheet. So the Fed is going to have to step in and start buying bonds at a more aggressive pace than they were previously, which does provide a buyer of Treasuries in the resort. So that's going to help stabilize yields and some of this concern about bonds are going to decline, et cetera. This also provides market liquidity because those bonds get bought from banks. And so when those banks sell their Treasury bonds to the Federal Reserve, that provides them that excess bank credit reserves. Those can then be lent to primary dealers, et cetera. That money filters ultimately into the markets. And that's why historically we saw a very high correlation between quantitative easing and the financial markets. So there's going to be more support for the financial markets as well. We would eventually get back to this point to where the Fed is not reducing their balance sheet anymore. At some point, we will actually start to see them reverse back to QE.
Catch me daily on The Real Investment Show. The link is in the description.